Okay, I'll do my presentation in English. As much as I'd like to be able to explain this in Spanish, it'll just drag everyone down here. My name is Douglas Cavey. I'm the Executive Vice President of Defiance Silver. As well, I work with a company called Orquest Consultants, and we consult with a number of funds, but one of the ones is the largest shareholder of Defiance Silver called Windermere Capital. So the purpose of this is just to sort of provide a bit of a toolbox or a snapshot into the capital markets and where the space is that we are right now, because it is the background of what drives a lot of the innovation and a lot of the mining exploration and development in the industry that we're all a part of. So what does it take to finance an exploration project? Where is the source of capital, and what are the current trends, or what are we seeing in the money raising side of the industry? So as I like to start out, and this is a repeat performer, mining is not a zero-sum game. We all perform together. So when your peers see success, you see success as well. When your peers do not have success or something bad happens in the industry, whether it be social, whether it be an economic factor, or whether it be something not driven by the mining space at all, like tariffs, that negatively affects us. So we do need to operate like we are one unit, and we do need to operate in a way that we know what our peers are doing, and we know where they are performing and what's working for them and what isn't working for them. Mining has a reputation, mining exploration particularly has a reputation as a value destruction of money. Almost 50 cents for every dollar almost gets wasted before it even hits the ground. So how do you go to an investor right now and say, this is a good investment, but 50% of that money doesn't even go into the ground? So I like to put this picture up here. Just because someone has ice cream doesn't mean that you need to be sad about it. So I like to recognize the success of a number of peers in here. We have the excellent team from Heliostar who have been really driving a lot of the M&A space in Mexico, driving a lot of financing space, giving us a good name in Mexico by taking projects that were largely shuttered or not seeing that visibility that they deserve. But then a lot of the smaller companies that are working right now, making exploration discoveries that are not being recognized and not seeing the financing that you would see in a typical bull market. So what do we do to learn what our peers are doing, and how do we find ways to co-create success? And conferences like this are excellent for co-creating success. Learning who is in the space, learning what they're doing, and what are they doing that's succeeding. And this chart, I was going to change it for today, but it's actually almost in the exact same place as it was in 2023. So I picked a group of our peers here, and what does it look like? We all trade together. Whether you're a 10-cent stock, whether you're a 50-cent stock, or whether you're a $20 stock. The market does operate in a very, very tight space, and we are a very, very small market relative to the tech space or relative to the venture capital space. We do not have a large market capacity. It doesn't take much money for a stock to move in our industry, but when one moves, the rest of them move together. So I have Vizsla and Defiance. I also have Imperial Metals there and a producer. So it shows you that when the stocks move, they go, when they're in line with each other. When they drop, they all drop. When they rise, when they drop. And even today, we had the tariffs delayed for 90 days again, and stocks are up. Well, gold was up $125 this morning, and all the stocks went. We're up about 45% with Defiance Silver. So where are we right now? I think right now we're sitting kind of on the cusp of 2006, 2007 levels. It hasn't changed from where we were in 2003. And I think the biggest leading indicator in the mining space is the M&A cycle that we're in. So before the market really took off and a lot of companies benefited here in Mexico in 2009, 2010, 2011 with open market buyouts, with hostile takeovers, with bidding wars between major companies. We had a number of major companies that were in an acquisition phase, a merger phase. So BHP and WMC, Inco and Vale, Rio Tinto, Alcan, Freeport, Phelps Dodge. These were some of the biggest names in the mining industry that all merged together between 2006 and 2009. That signals that there's going to be a trickle down in the M&A. The largest product that is available has merged together, and those big companies, which is a result of high commodity prices, see a trickle down because of the amount of cash flow that they have, and look at the smaller spaces. So what have we had since 2003 or 2021 until 2024? Almost twice as much money has been spent in the M&A cycle between major companies merging and then the trickle down into smaller companies, such as the Teck and Agnico San Nicolas purchase, or even Heliostar, who's in the room today, with their acquisition of the Argonaut assets. We haven't seen that major consolidation or that major acquisition occur at the level that we did in 2006 and 2007 in the more metal-focused space. We did see some of the lithium space go with the Alchem transaction in 2023, but what we haven't seen is that trickle down where you're seeing the smaller or mid-tier companies merge together. It's happening, it's going to a standstill, it's happening, it's going to a standstill. And what we hear is that there's a number of them in the works right now, and I think that's going to be the next kind of leading indicator of where we are in the bull market, which is yet to appear for us. The market does follow similar patterns, and unfortunately, it does get held off by, the market being at a bottom, no M&As happening. So we have the bottom, I can't see that right now. We hit the bottom on that purple line there. The market's at the bottom, we don't see any M&A. Market rises and we see a consolidation and an M&A cycle happen. Why doesn't that happen at the bottom? Because companies are scared to invest at the bottom of the market. They don't have the cash flow at the bottom of the market. They're preserving capital for investment into their own assets. What happened again right after the global financial crisis, 2010, 2011, a parabolic rise in the commodity prices. That's what that blue line is, commodity prices. A parabolic rise in the commodity prices and another major M&A cycle between 2010 and 2013. We saw a trickle down in the commodity prices, not down to the levels of 2009, but we did see a trickle down in the commodity prices down to levels that were, enough to see a generalist investor show back up in the space. The fundamentals were good. And then we're back up into the 2020, 2023, and another major M&A cycle. So what does that indicate? And this is in 2023 that I last said this. We're not at the bottom yet. We have seen that chart come back down. We're seeing that chart almost hit that purple line again. That's where we are right now. So where do we see after that? Another rise and another M&A cycle. I'll say this time and time again. M&A is one of the best leading indicators of a bull market. So what can I make up about this? Major M&A has traditionally been a leading indicator of a period of growth for small cap mining companies. And historically, the trickle-down hits the mid-tiers first and then the small-cap companies after that. And that's just as a result of companies having cash, access to capital, access to favorable lending rates, and really a positive outlook on what M&A they did previously to that and how that's going to fund their development cycle moving forward. Big projects get bought at any time during this cycle. There are standalone assets that can happen. Look at Kinross and Redback Mining. Things happen outside of that trend, but largely that consolidation happens in a period that's supported by commodity prices, by where companies are in their development cycle, but as well that good projects can't sit on the sidelines for too long, and there tends to be a lot of people running in the door at the same time. Right now, majors are making lots of money. Some of them are not reporting the best financials. They have, they put a lot of money into their capex. They put a lot of money into their development capital of their assets. But today's commodity prices are very favorable for some of the majors' operations. And then we saw that with the polished up asset, a Cisco and Goldfields merger that happened last year. Good assets are getting bought right now, and the product is very low. And as someone who spends a lot of time looking at new assets, while there is a lot of deal flow, there isn't a lot of good deal flow right now. Right now we're in a flat market. It's not easy to raise capital. It's not easy to get your foot in the door. It's not easy to raise capital for speculative exploration. And bad financing has been happening across the board, and bad financing has been killing deals. Right now, the best place to be is in a trickle-down M&A environment by consolidating assets, by looking at your peers, saying who is the best fit for us, who is the best, management and operational team for that asset, and how do we unlock that asset so we can tailor it to put it into the hands of a company who is going to advance it. So if you're a small cap company and you're trying to put the first drill hole into a out of range porphyry project, how is that going to sell to a major company who's going to look at that and say, well, that's going to cost you $50 million, so let's sit on the sidelines with that. Same thing goes for a company that's got a big advanced asset like we had with La Preciosa. That project was 240,000 meters of drilling into it, and we couldn't do anything else with it at that point. We needed to look for another company, a bigger partner, which was Corp in the end, to come and take that asset and put it through feasibility and take it into production, which it'll go into production this year. We're not in that mid-tier to trickle-down space right now. Small caps are still small caps, and therefore we're in a very, very precarious situation in that we have a limited access to capital. We have a limited runway of how much work we can do with the capital that we have. And we have a highly competitive pool of people looking for the same amount of capital with a lot of the same outlooks, a lot of the same futures for those companies or for those projects. So who needs to raise money? And if anybody's an explorer in this room, your hand should go up. We all need to raise money if we're exploration companies in this room. So raising money for preparation into a commodity bull market. What do you need to do? You need to prepare your project with a very clear 2 to 5 year development strategy, and this takes time. I'd like to say that we're masters at doing that, but we're not, because it changes. It changes based on the commodity prices. It changes based on the socioeconomics. In Mexico, it's changed a lot because of the mining regulatory regime that we've been under, as well as the less than fortuitous outlook on permitting. That's really gotten into the heads of the investment bankers right now. It's hard to go into a space and say, I'd like to raise money for 2 to 5 years worth of work, unless they understand what you're doing and they know your team behind that. You need to prepare a very, very well-researched and targeted marketing strategy. And I think this is often overlooked in how much time and effort needs to go into marketing your asset to the right people, to getting into the door with the right group of people, the right financial partners, because those financial partners are not typically looking for an exit in 1 year. They're looking at, what is this asset going to look like 3, 5, 10 years down the road? It may not be Defiance Silver that owns that asset. It may just be Minera Santaremi, our holdings company. It may just be Minera Santaremi, and how that has trickled down into various different shapes or format of an ownership of that company. And a lot of the investment banks in Europe are looking at it like this. They're looking at the companies and saying, hey, we like your asset, but we know that you guys aren't going to build it, but we'll invest in your company so that we're now owners of that holdings company. One of the best things you can do is not to fall in love with your asset. Bad management can ruin a world-class asset, and very good management can take a mediocre asset and take it into something. If you fall in love with your asset, you turn the blinders on, you stop looking at what is the bigger picture of your asset. So do be sector agnostic, but also be project agnostic. When you find a roadblock with your asset, you need to communicate that to your team, and you need to understand whether that roadblock is something that you can move past, whether you can tackle it, or whether you can say, hey, we can't do anything with this. Now it's time to look for the best partner for this asset. You need to understand what your potential exit strategies are. What are your liquidity events? Is it going to be a buyout? Is it going to be outright, is it going to be a targeted acquisition from a major company? Or are you going to try and develop it yourself? These are three very, very different strategies. And if someone comes into the room and says all those three things to me, well, how are you going to be focused on all those three things? You need to understand what those exit strategies are, because when that M&A cycle goes to the top, as you saw, the market's at the top, when that M&A cycle goes to the top, everybody is running in the room. All of the M&A happens at the same time, and it happens in a period of usually 1 to 2 years. And if you hang on to that asset and you're not part of that M&A cycle, you're going to be hanging on to that asset till the next bull market. So another 3, 6, 8, 10 years, or at least 10 years in the silver space right now. One of the most beneficial things you can do is know who your peers are in the space, who your competition is for financing, but also what are your peers doing? What kind of return are they getting on their investment? Who are their key investors, and what are they investing in, and why are they investing in that company? So it pays to know who your peers are. It pays to know what are they doing. It pays to know who are they being financed from, and then to put that targeted marketing approach to go and really just focus on that group, alongside of creating new ways to access capital. So some of those ways are looking at a company that has a really good shareholder list and saying, let's go acquire this company, because then we bring those new shareholders in. It exposes you to a new group of shareholders, and it exposes you to a new platform of ideas, because you now have that new group of people that you've been working with, and you're engaging with a new market and new potential shareholders. And then the biggest thing is you got to be different. Not too radically different, but do something a little bit differently than everything else. Like, do something that is breaking the trend, because we get stuck in a rut and then we get grouped together as, oh, you're a junior exploration company. You're just like the rest of them. And it's very easy to look at a junior exploration company and say, you're just like the rest of them. Every dollar that I spend in your company, 50 cents gets wasted before it even hits the ground. Or as we like to say, the check is in the bank and spent before the ink dries on the check. So what are the most common ways of accessing capital right now? For private companies, private financing, some of us have been involved in those. Those are typically the least liquid, the least capable of selling. So you buy that private stock, and you put a lot of trust in that team to execute on their plan. So you've got to understand what they're doing. You need to understand what their strategy is, and you're really hanging on to the end until a transaction happens. Those are very, very, very beneficial for the right team, and those have created exceptional returns on investment, but they operate on a longer term horizon. It's very difficult to sell that stock once you own it. You have public equity raises, which a lot of us have been involved in, not as much as we have in the past, but those public equity raises, private placements, or creative raises in the public equity spaces are pretty uncommon, but we do have an equity window. And you really need to recognize that that equity window is open, and you need to hit that equity window. Until today, that equity window was closed. And then Trump delayed those tariffs another 90 days, and my phone has been ringing because people want to give us money. It is very, very chaotic how often those equity windows open and close. And you need to be very, very keyed into when that equity window opens. When those equity windows open, people will throw money at you in order for you to develop their asset. And you have that list of people, as I said in the last slide, you have that targeted list of people who understand what you're doing. And when that equity window opens and you say, hey, this bank is giving me $1 million, $2 million, $3 million for whatever work that we're doing, the rest of them come in quite quickly, and you can quickly, oversubscribe a financing, which, we were privy to do that at the beginning of this year, where we went out to raise $1.5 million, and the equity window opened, and we doubled our financing in 4 days. Traditional lending, debt credit facilities, those are seen as a very positive when you're developing a mine, quite a bit of a negative when you have an exploration project. They typically come with a security based on the asset, so you do want to make sure that you are very careful about those types of financings, particularly as a smaller company, but those are seen often at the bigger levels. And then you have your forward sale contracts or your offtake agreements with people like Ocean Partners and some of the other groups that are in the room here. And then the last two that are, of course, more common in the bigger space right now. We're not so much in a royalty arrangement or a royalty market, but royalty sales on the project. So understanding where does your royalty held, can you secure that royalty, and then bringing that royalty partner or bringing that royalty in for a future sale, and then looking at that, like who's the partner that you're going to bring in, someone like Oramet, where you have, okay, we'll sell you this royalty now, we'll give it to you at a good deal, and that's going to come with some type of other financing, whether it be equity or debt. And then the last and probably the most common for the smaller companies, other than public equity raises, are joint venture or strategic partnerships. So you look to a company who understands your team, who understands your asset, and they say, we like what you're doing, we like what your success is, we like that you guys have been able to finance your asset, we'd like to participate alongside you, either at the project level, at the financial level, or in a joint venture. You really need to know who your audience is. Respect the knowledge of the listener. A lot of the bankers that you go in the room with, they're not geologists. You're not going to be able to sit in that room and talk about, what the potassium levels are in a porphyry, where you are, how, vectoring into a porphyry means this. They just want to know, how are they going to make money? You need to make that as clear as possible to them in as few words as possible. How are they going to make money? They can understand when, they have an idea what the market's going on, they know where we are in the cycle, they have their own idea, and you're generally not going to change that. So you need to know your audience. If you're presenting to a broker, if you're presenting to an investment banker, keep it as high level as possible. Make sure that you have a strong, relationship with them. Make sure that you make clear milestones that they understand and hit those milestones so that at year 2, when you're in the door again with them, you can say, we've hit all these milestones. We did exactly what we said we were going to do, and you've kept it at a level that they understand you. It's very, very important that you respect the knowledge of your audience, because while you may be an expert in exploration geology, they're the ones who are going to write the check for you. You need to respect that they know where they are in the market, and they have the checkbook that you rely on. So keep it so that they understand it. Make sure they understand what you're doing. That's going to help you at the end. If you understand what you're doing and you can communicate what you're doing to them and they understand it, it's going to be a lot easier when you go into the room after the second raise and say, we need twice as much money. So typically when I'm doing a presentation or I'm doing a one-on-one with a broker, if I'm with a banker, some questions that I like to ask at the end of that is, are you a shareholder? Or even at the beginning, are you a shareholder? It's really good for us. We're all shareholders of our companies. So are you a shareholder? Do we have some common ground? Is there anything that I'm talking about that you don't understand, that you need specific, explanation on? Very seldomly will someone ask a question that makes them look like the dumb person in the room. But it's that person who wants to ask whether I should have my shoes tied right now is the same person who's going to ask the most important question, when do you want this money by? Make sure that you target the audience and make sure you understand what that audience needs and spend the time to make sure that they're getting the answers to the questions that they have, because those questions are going to come up 2 months down the line when that deal's about to close. Those questions are going to come up in the due diligence period, and that's going to slow you down another week, another 2 weeks. From the start of a financing till the end of a financing, it takes approximately 6 weeks to 2 months. And with multiple tranches and multiple people playing alongside that, you don't want to be spending your time answering due diligence questions when you want to be spending your time collecting subscription agreements. And get used to be saying or told no. So for every 100 people that we approach on a financing, 1, 2, or 3 are going to answer yes on it. So you get told no, and you get told, thank you very much for your time. It's time to, we're for our next meeting, because they have 10 more people who are doing the exact same thing as you, who are asking for the same amount of money to really do a very similar thing. Put a company in the right space at the right part of the market, and then see the returns from there. So if they say no, that's not a bad thing. Try and take some type of criticism, try and ask them what it is that they said no about, and see if that's a question that you can answer, but not at that time. Give it some space, give it a bit of breathing room. So now that you've raised some money, what are you going to do? Shareholder engagement. That's your traditional investor relations. The shareholder engagement is very, very, very important, and it has changed dramatically since the last bull cycle. We're no longer doing so much, picking up the phone and phoning everybody, although some shareholders like that. It's a lot more marketing on social media. It's a lot more involvement in tech conferences. It's a lot more involvement in online conferences. It's a lot more disclosure that can get you in trouble with the different types of securities exchanges right now. Once you lose interest with the shareholder, it's very, very, very hard to get it back. So your number one focus after raising money is to keep your shareholder engaged and ensure that whenever you get a question, you answer it. And it takes a very, very dedicated team of people to do that. So you need to know your shareholder base, and then as a result of the current market that we're in, one of the best ways to keep them engaged is become a master in social media. That doesn't just mean you're going online every day and putting out a social media post. That's who is making the most posts out there? Who is doing the most investor relations for you? Bring them into you. Make sure that you know who they are. Make sure you communicate with them. We've got our top 10 social media guys that are posting across the market. We really do engage with them on a personal level, and we don't try and tell them, this is what's happening in advance of things. It's what are you doing? What are your questions? Make sure that you can answer those questions, because they're the ones who are your front line, and that's way different than it was 10 years ago. It's not so much the newsletter guys anymore. It's not so much the bulletin boards anymore. It's very much this sort of social media Illuminati that exists, and they are very, very powerful. They can control, at least on our stock, they can control 20 to 40% of the daily average volume of our stock, which is about 800,000 shares a day, or 200,000 shares a day, that this social media group of people, or this internet communication group of people are having an influence on. So it's very, very important that when they talk to you or when they reach out to you, you are in control of that conversation, or you're giving them what they need to know, because that makes them look good and that helps grow their base. So it's sort of a win-win situation for them. And that constant communication right now, I just put up a kind of a series of what we think is working the best, but social media, video, podcasts and videos around news releases, webinars, newsletter updates, sort of a monthly update, and then site visits. So as a result of COVID, we haven't seen a lot of site visits happen, but in the last year and a half, they've really gone kind of parabolic. We're getting people reaching out to come visit our projects. We're trying to get as many of them organized as possible, but at the same time understanding what's the value. If we're not trying to raise money, why are we bringing too many people onto the site? Okay, so what's the 2025 lookout? We saw this and we've seen this a lot. Very short but very heavy pullbacks in the market. So last week we had an approach on tariffs, or an attempted approach on tariffs. That knocked most of the silver space down to close to its 52-week lows. This morning we had the 90-day suspension of any tariffs, and that brought most stocks up 40 to 50%. So what does that mean for the trader side of things? So the generalist trader who's trading in the macro environment. That sell-off was them going to a liquid. They're trying to get as much cash as possible. That sell-off, they sold at the top of that sell-off. They saw it coming. They sold that market down. They bought that market at the bottom, and they've been buying it over the last 2 days. When things are very, very volatile, the most important thing is that you preserve your cash. So you can expect every time that one of these tariff situations or any global macro financial, whether it's even just a macro financial sort of blurb that someone says, when that happens, these markets are going to pull back, and they're going to pull back very hard. That closes the equity window. So if you don't have a cash position and that tariff situation operates for 2 months, then you're not going to be able to raise money for those 2 months. So recognizing that when you do have that equity window, which just this morning it opened up again, might be a really good time to go to your bankers and say, hey, I'd like to raise a little bit of money right now. Just enough to keep the lights on. Because if these things keep happening, and they do happen, we've had 3 of them happen since January, you're going to see that these big investors, the macro investors, are going to go to cash. They're going to preserve their net worth with cash. Most of the currencies that they're trading in are doing quite well. The euro and the US dollar is a very strong currency right now. They're going to go to cash, and they're going to wait for the buying opportunity, which was last week. And then you're seeing that today with a lot of the stocks rebounding the way that they did. We're seeing a very healthy chart for gold and silver. One of the healthiest charts that I've seen for a long time. In 2011, what we had was a very parabolic chart. When you have a very parabolic charts drop as fast as they go up. So if you have a parabolic chart over 3 years, you can expect on the back half of that 3 years, you're going to lose all your gain. Now we're having these, corrective pullbacks. So we're seeing a very much like a Christmas tree almost, or the front side of a Christmas tree. And that's a very healthy chart for a generalist or a value trader to jump into. They're not looking for the parabolic chart. They're looking for the length of time that they can successfully invest in a space, because when it pulls over, they don't care if it's pulled over at the top there. They know that that pullover is going to be the same amount of time on the slide back. That's very, very, very positive and very healthy for a chart that we like to invest into right now. We're hearing this a lot when we're going on the street, that this is a very healthy chart, this is a very healthy sector, but the volatility around the trade agreements, the volatility around raising capital makes this industry still a bit suspicious to the larger investment bankers and the larger investment houses right now. When cash pours back into the market, it's a very healthy sign, particularly that we're a very small sector. All of the mining companies combined in the US and Canada are smaller than Apple. So when the market goes volatile, we see that almost detrimental slide on our stock price. But then when the market goes positive, it does jump back quite quickly. And we saw that again over the course of a week here. We're not in a bull market yet. I don't care what anybody says. We're not in a bull market yet. But good projects are being bought. So back to that M&A cycle, we'll see that as these good projects get bought at the prices that we're at right now, that is going to lead to a bull market, although I don't think we're there yet, and I don't think we're going to be there for probably before the end of the year. Due diligence periods right now for that M&A cycle favor the investor. They don't favor the company. It is a good time to be a buyer right now. You have time on your side. If you have cash on your side right now, it is a great time to be an investor. If you're on the selling side of things, if you're a property vendor, you're in a tough position. You need to have the capital allocation in order to survive that due diligence period. And so capital preservation is key. All commodity cycles in the past 20 years have experienced a parabolic destructive event in advance of a major bull run. Probably the second most recent one was the COVID event. COVID event nailed the markets, and then we had a massive run after that. Are these tariffs that parabolic event or that destructive event in advance of a bull market? I'm not too sure. We could see some other things happen. We have wartime events right now. We have a destruction of a number of major trade partnerships. We have what could be currency destruction across North America. But we have seen a major destructive event in advance of every bull market of every commodity cycle in the last 20 years. When we find that bottom, that is going to be the lead into the bull market. I don't know where that is, and if I did, I'm not sure I would be standing here. So that's pretty much it on this side. It's not much changed in 2023. I was going through this presentation, but I would like to thank our partners, Orquest, Defiance, Windermere, Ocean Partners, Major Drilling, a lot of the people in this room that we've worked with and we're very happy to work with. And as I said, this is not a zero-sum game. I applaud the success of my peers. I applaud everything that everybody's been doing in this room. I'd really like to thank the team at the Discoveries Conference, Doug, Adelina, and Temple. This has been a fabulous conference. We're very happy to be here. We'll be around for the next couple